Welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Each episode, we welcome a guest to the show to share their news story of the week. And I'm delighted to welcome James Lawrence, CIO of Smart Pension, to the show. Welcome, James.
Hi, Charlotte. Thanks for having me.
Great to have you on the show. Do tell us, what is your news story of the week?
Yes, my news story of the week is around DC Megafunds and how there's some research that said there's no correlation between the scheme size and level of investment return. I think this is just such an interesting topic at the moment. There's obviously a big push by the government to grow scale, with a lot of kind of insinuation that that's going to lead to better returns and better member outcomes. I think the argument's a lot more nuanced than that, and actually as a provider that sits at a kind of a mid-scale level in between small and large, we're kind of caught between the two arguments and the two camps at the moment. So it's super interesting time for this type of discussion.
I mean, if one was to be cynical, you can completely understand why, as you say, a mid-scale player, you would find this news story of the week fascinating. But I do empathize with you, because I do think that we have kind of like just decided that bigger is always better. And we have forgotten that, we talk always about economies of scale, but we forget about the fact that diseconomies of scale also exist. And it very much exists in investment and asset management. I mean, there are very clear reasons why certain asset managers, when they're running certain funds, decide to only raise a certain amount of money and to stop after that point. And I know that's an asset management perspective, but the same theory applies also when you are an asset owner. So, it's really interesting debate, as you say, because it all seems to be rah, 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 bigger is better. But if we think about what the government also wants to do when it wants to invest in small companies and UK productive finance, if you get to the stage where 2% of your portfolio is still £1 billion and you can't be bothered to invest anything less than 2% of your portfolio because it's not really worth your while in terms of resources, and then something's less than $1 billion, you can't even do that. Or you become the sole investor in that one fund. It's an interesting debate that I think has kind of got slightly left on the side. How do you think about managing size and making sure you don't fall into that diseconomies of scale trap at Smart?
Yeah, it's a really interesting point. And actually, I think sometimes when we talk about scale, we forget why we're talking about scale and what we're trying to achieve from scale. It's not focused enough on the outcomes of scale, which should be better returns, better member outcomes, lower fees, etc. And actually, there's lots of ways of achieving those things without pure scale by itself. And actually, as you say, you start to get into negative economies of scale at certain points. I'm sure we'll come on to the, Charlotte, but also the direct investing piece that you have to end up probably getting to as you reach scale is a really interesting segment within this market, because you've got some players, people like Nest, who are kind of not yet gone down that route, despite the fact they're at 50 billion plus at the moment, and counterparts across the world have probably started doing a lot more of that. So part of the way we look at scale is just giving us the future flexibility. So with our private equity in particular, where you mentioned, small opportunities, small ticket sizes, small companies that is incredibly difficult to invest in when you're a large scale player. We've used the funds of funds, or we'll be using a fund of funds manager for that. So they've got the teams, they've got the relationships with thousands of different GPs across the globe, and they can find those opportunities for us at the right size and scale as well.
Yeah, and I mean, even if you talk about private equity, private equity can be actually pretty big investments depending on where you are on that chain. If we're thinking about venture capital, which has been sort of being the government's bonnet, the past government's bonnet, but to be fair to both governments and policyholders, if you think about sort of investment logically, new innovation, and we see that tech is a great example of that. We see lots of waves of creative destruction. So we do get into sort of oligopolies too, but new investment is going to come from somebody's going to invent something somewhere in a small company, whether it's tech, whether it's something else. And do we have enough funding to get that company all the way from that small idea all the way to the submax, the size it can be. Because actually, I think we do really well in the UK and Europe in terms of innovation and creating new companies, but it's the path, the capital path all the way that's tricky, isn't it?
It is, yeah. I mean, we've historically, and it's a pretty well-known issue, had problems with scale-up capital in the UK, and our best companies and our brightest minds go off to the US to make serious money. I think they make good money, but then they make their kind of serious millions and billions in the US. And obviously, we're seeing that with things like Anthropic and OpenAI and some of the IPOs that are coming out, which is huge amounts of money for pretty new companies in the grand scheme of things. And I don't think yet in the UK and Europe have that level of infrastructure. We don't have the kind of benefits of some of the listed markets that the US have as well. But, the scale that this is kind of opposite to the argument that we were kind of talking about earlier. Some of the scale pieces actually helps with those. I don't think you'd be able to get small £1 billion pension schemes investing into the Anthropics of the world, but you would be able to get investment into it at 50 billion, 100 billion, those kind of scale. So there's pros and cons, yeah.
And you mentioned that you go the fund of fund route, which I think logically, if you kind of think about this issue, you can sort of like do a big private asset allocation with a large asset manager. But then you need, if you want to specialize and you really want to unearth those growth opportunities, you do need to go a fund of fund route. And the reason why fund of funds is unpopular is because we've already got private assets that are expensive, and that's a whole new layer of fees. How do you manage that so you don't just end up spending all your money on fees and nothing on returns?
Yeah, and that's definitely the downside to fund of funds. And there's a few levers we've pulled to make that possible. Firstly, getting fee budget elsewhere in the portfolio, I think is kind of often overlooked. There's lots of different ways you can find fee budget, and we've done it through interesting equity solutions, amongst other things. Secondly, finding the right fund of fund manager is really critical to that. There's those that have access to new and emerging managers, and there's often kind of cornerstone fees that you can put in place there, particularly if you're a large asset owner and you can put tens of millions into VC funds that are new and up and coming. Obviously, we need track record and we need the good people in place, but particularly more early stage VC, some of those ideas you can get a bit of a discount. And also the usual kind of co-invest route as well. So putting some level of co-invest into portfolios is helpful. So we're going to have a pretty good split between primary, secondary and co-invest. We've seen others probably a bit too heavily weighted towards co-invest, in my opinion. I think it becomes quite lumpy, a bit undiversified, and you can't get the kind of target sectors and geographies that you want sometimes with those deals, but it's necessary. So it's a bit of a blend of levers to get a fund of funds working.
Okay, so tell us a bit more about that. So and you've got, explain to us the different ways that you can actually invest. What does co-investment actually mean? Because it's a phrase I hear bandied around all the time, but I'm not sure that if you ask me to explain it, I'll go, well, obviously it means there's more than one investor. That's what co means, right? Co stuck at the front of any word means there's more than one founder, investor. So what's the different routes? Can you explain that a bit more?
Yeah, so private equity is a great example of overcomplicating things, I think, sometimes, and there's definitely some discussions in the industry by some interesting players around the pros and cons of private equity. So we need to make sure we're on the right side of these things. But with co-invest, the main way of investing in private equity is through primary investment, where you are giving a fund manager usually some money and they're putting it directly to work into that company. You own an equity stake. You usually kind of sit on the board. A lot of the time you might have majority ownership, etc., particularly for early stage companies, and you have a lot of sway. There's a lot of opportunities where companies are trying to raise money, but they don't necessarily need all of the kind of benefits that come with primary ownership, like board seats and control, etc. And that's where co-invest comes in. So it's companies raising more money, but sitting alongside more primary, more direct investment with more power and control. So it tends to be fee-free because it's seen as a benefit to investing in primary funds. So big private equity funds will usually kind of give that out for free as a kind of benefit and a loyalty bonus in some ways to their clients. But actually what we're seeing at the moment is lots of private equity funds are siloing it off into big asset owners like ourselves and others and offering it, as part of a fund itself without the kind of need to go into the primaries as well. So yeah, it's basically a way of getting money into a company, you limit control, and there's some downsides to it. You have to move quickly, but it tends to be fee free and pretty cheap.
Mm-hmm. And then is that the same as co-investing, or?
So that is co-investing. That's what I mean.
Co-investing.
Yeah.
And if you don't co-invest, what's the other option? How else do you get in?
Yeah. So the primary route that I mentioned at the start there is the main way that most people invest. So they go in.
There's two options: primary and co-investment,
and secondaries as well. So you can buy stakes off of somebody. So primary stakes is when you're making that kind of first investment at a funding round. So series B or C, early stage, for example. Secondary, you can then buy that stake off of somebody, usually a private equity fund, and their underlying investors at a later stage. The benefits of doing that tend to be you're a bit later stage, so you've probably missed some of the J curve, for example, that you get from really early stage investing. A lot of discounts you can get, so you can tend to buy secondaries at a bit of a discount to where their kind of valuations are, which maybe is a bit of a signal as to where private equity valuations are in general, if you can buy everything for a discount. But they're the kind of three main ways of doing it. There's other kind of small different ways as well, but they're the three main ways.
And if we're not doing private equity, if we're doing, because as I see it, there's sort of four asset classes within the private asset universe. If we're going a private credit route or an infrastructure route or a real estate route, does the way you invest change?
Yeah, it's tending to get quite blurred in a lot of these asset classes now. So, for example, real estate and infrastructure are becoming a little bit homogenous. If you think about a data center, for example, is that infrastructure? Is that real estate? Is it something in between? So the asset classes are getting slightly blurred. The ways in are slightly different. You can have real estate debt, infrastructure debt. So that's obviously just providing basically leverage to those companies and those projects, or real estate equity, where you're actually taking ownership of them. We've done infrastructure in an equity way with Octopus Energy. So we're owning projects, particularly renewable infrastructure projects across the UK. And then, as you mentioned, private debt as well. There's lots of different ways of doing that. Direct lending is probably one of the bigger main ways. So it's the kind of traditional lending directly to companies. And that's what we do with our manager, Clearlake.
I mean, also, where you are on the kind of the equity versus debt side of the equation will depend on where you are. And I mean, for a DB, there would never be in the equity side of the equation. Insurance wouldn't either.
Yeah.
But from your perspective, it might depend on where you are on the member's journey. Are you in the growth phase, pre-retirement, or even at retirement phase, right?
Correct. Yeah. So in our growth fund, we pretty much, there's not a huge amount of debt in there. And we're reviewing some of that at the moment as well. The debt that we do have, it tends to be a lot more equity focused. Where we do have debt, it tends to be much higher up the spectrum of kind of risk and illiquidity around private debt in particular. And we're seeing lots of our peers look at things like CLOs and other different forms of structured credit, which is definitely
we were talking about on the last episode of the podcast, talking all about CLOs.
Yeah, exactly. I think they're in vogue at the moment for sure.
Yeah.
And then again, there's different, I mean, as I said at the beginning, the finance world has become a bit of a juggernaut in terms of overcomplicating things. There's different parts of CLOs that you can take equity and kind of higher senior level if you want risky or not as risky. So, but yeah, you're completely right. We don't need income early stages, same as our peers in this space. But income does become helpful later in life as you're getting towards retirement. That's where private debt, real estate, etc., can be more useful.
Okay. And the other thing you kind of like alluded to at the beginning, we talk about Nest, there's kind of there is a big debate, isn't there, going on as all of these pension schemes and asset owners become larger about whether you should be doing this externally or in-house.
Yeah.
And Nest has obviously stuck to its external route. And interestingly enough, just to kind of like stir the pot and make things less clear, we've got a lot of debate, haven't we, in pension schemes that are more mature in Australia and Canada, where they very much went the internal route and now are beginning to wonder if that's a great idea and try and pick it. And if I wanted to stir the pot here, I could say we could have a similar debate about USS maybe. But there is it kind of like, so what are the pros and cons of the internal and the external route, and where do you kind of fall on that debate?
Yeah, I find this debate really interesting. And we're similar to Nest. I mean, we're at 10 billion at the moment, which isn't scale enough to be direct, if I'm being completely honest. Mm-hmm. We look at it every year, and we have frank discussions internally on our investment committees and trustee boards, etc. And I think the right numbers is probably kind of 40, 50 billion plus. Those types of figures is when it starts to make sense. Really, the only reason in my mind you do it is fee savings, you're basically taking investment managers' margin away from them, bringing everything in-house. That's pretty much the only reason you do it. There's arguments about control as well for doing it, but realistically at the scale we're talking, and for our scale as well, we can build whatever we want with asset managers, and we can have fund of funds, and we can have that flexibility with them directly. I can see why Australian pension funds and supers have started to bring it or take it away from in-house. I think the level of complexity is very underestimated when it comes to direct investment. One of the other problems as well is you're trying to recreate what an asset manager does, and that's very difficult. You're trying to bring effectively a culture or a network in-house. A lot of the times they don't get paid as well as they would externally because they're trying to save costs. You don't get the amount of carry if you're private equity, so you're not always going to get the best of the best. They're going to stay in the big Sequoias or KKRs or whoever it would be that actually can pay these people millions of pounds a year. So, and then operationally, there's a lot of risk that you're taking away, or you're taking in-house by doing that. So we're very cautiously looking at it every time, and we think it's, particularly for DC where it is at the moment, master trusts, the amount of scale and money coming into these providers and ourselves and others means that we get some really great fee deals, really great products, and lots of flexibility and everything you need right now. But it's one to keep an eye on.
I mean, I genuinely find it hard to understand why you would build something eternally, unless it's. I mean, you wouldn't even do it for passive. You definitely wouldn't do it for passive equities because you're not going to be able to compete with the costs. So when it comes to private assets, as you say, there's a lot. Sometimes I think people underestimate how much expense is involved in building an asset manager. I mean, we are operating in a highly, highly regulated industry. Mm-hmm. So there's a lot of capital expense up front. And then as somebody who runs their own business and has done for a long time, human beings, we're very bad at estimating how long it takes time for things to come good. We overestimate how much we can do in the amount of time available. I mean, the idea that you could build an effective asset manager in anything less than 5 years, I think, is for the birds, because I think it takes 5 years to build any kind of industry or any kind of profile, really to kind of get significant traction. That's a long time. It's a long time to bear a lot of expenses. And as you say, how are you going to attract people or kind of like recreate the brand of something like Sequoia or KKR, which have been around for multiple decades? It's tough, isn't it?
It's really tough, yeah. And I mentioned it and touched on it, but the kind of culture as well that you're trying to replicate to get. I mean, venture capital is such a different culture to buy out private equity, for example, and you need that network, and the deals get done by who you're talking to every day. And I imagine these companies have got hundreds of people that are spread out all across the world talking to each other, and you just can't replicate that if you bring 5 people in house to try and source deals. So, yeah, as I say, I think it'll be a long time before we see any big DC master trust properly go direct, but I might be wrong.
Yeah, well, let's we've plenty to talk about. Keeps the professional investment podcast going for many, many more series, which is good. So we touched on infrastructure as well as you mentioned private equity. We touched on the 4 different types of private assets, and one of the things, obviously, again, thinking about government policy that they want pension schemes and asset owners generally to sort of put their hand in their pocket for is green tech. It's a really important part of an infrastructure portfolio. And I know, for example, it's probably if you were to do green infrastructure with a fixed income structure, then you would have insurance companies probably biting your hand off. How do you think about playing your role in that and investing in green tech? Is that a part of your portfolio?
It is, yeah. So the infrastructure that we've got so far is pretty much is all renewable infrastructure. So it's green technology, but it's also building wind farms and solar and the energies of the future, really. And we made our first investment in December last year, and we're about to be fully ramped up with Octopus, who've been a fantastic partner on this journey for us. because they're not only in the ecosystem, they basically drive and build the ecosystem themselves. We did it because it was an interesting opportunity at that point. For infrastructure equity, we're looking at high single digits, early teens type returns. It's also inflation linked as well, which has been really helpful in quite difficult times and will be helpful going forwards as well. But I think the main thing for us is building things that actually make a difference to people on the ground. It's quite easy sometimes to see big figures, 10, 20, 30 billion, and forget that there's people's retirements and lives that sit behind those figures. They might have £10,000, £50,000, whatever it might be. That's their money. We're also conscious that actually some of this can be a little bit contentious and politically driven. So the way we think about it as a trustee board is we want to invest for the benefit of our members, and we don't want to overlay our values as the trustee board or a CIO, whoever, onto that. And so it has to stand up from an investment's perspective, but it also has to stand up for making a real impact. So that's why we picked someone like Octopus, because on the face of it, there could be people that say, I don't really want wind farms in my area. But actually what Octopus do is, if the wind's blowing quite hard on a certain day, they'll give people in the area free electricity, because that's how they've plumbed into the ecosystem. And you'll be not too surprised how many people then love wind farms in their area rather than the other way around. So we're trying to turn things that are quite politically charged at times into things that really benefit people, and actually listen to what people truly want. And particularly with the way the world's gone in the past few months around conflict, the Middle East, gas prices, etc., actually building out energy security for the UK is just really high on our agenda as a pension fund.
Yeah, it's funny, isn't it? How I don't know whether it's because the pension schemes bill has now become an act, or so we don't have that to sort of obsess about all the time, or the fact that we now have oil prices tripping all the way back up again because of Trump's adventures in the Straits of Hormuz. But it's funny how once oil prices start to rise, we keep going, yes, energy security, that'd be nice. Maybe we should give this green tech a bit more of a focus, and it bubbles back up the agenda.
It does. And it's always made sense to do, to be honest with you, but it hasn't been in, as strong focus as it has been in the past few years. So if you look at lots of countries across, look at China, for example, look at Spain, they've been investing into energy security for long periods of time. We just haven't done a lot of it in the UK yet, unfortunately, but that's partly where our role comes in.
Yeah, and Spain has obviously the sunshine, and, perhaps the most gifted country in the world might be sort of South Africa, because they have both the wind and the sunshine. But yes, and Germany, I think I had a civil servant said Germany's got the biggest problem with renewable energy because it has neither wind nor sunshine. We have plenty of wind and intermittent sunshine. But it's kind of like, as you said, I used to talk a lot about sustainability and ran a whole sort of series of events around sustainability. So it's quite interesting that it's bubbling back up and coming back up the agenda whilst we continue to experience global warming, and it hits 35 degrees at the end of May in London.
Yeah.
How do you think investor, aside from political shenanigans that push things back up the news agenda and into people's consciousness, how do you think investor attitudes, whether that is you, the asset owner, the asset manager, or even the scheme member, their attitudes to sustainability and net zero are evolving?
Yeah, I'd say, as an asset owner, we've tried to always be fairly pragmatic about this. Lots of these things, and I wouldn't call ESG a trend, but trends tend to peak and trough quite a lot. And actually, if you end up somewhere in between the two all of the time, you tend to be in a fairly sensible place. And I'd say with something like ESG, most people are pretty pragmatic and rational when if you speak to them. I think people, when it's become politicized, have not liked, their short-term problems that you get from some ESG investing, people losing jobs, particularly in oil and gas that we've got in kind of Scotland or wherever else. And that's a completely irrational way of thinking about things. So I think as long as we, as an asset owner, are thinking rationally and long-term and not jumping straight into things that are going to cause problems because we're trying to save the world and save the planet, as noble as those things might be, we just have to be conscious of the real people that sit underneath these things. So yeah, we've not changed our stance too much. We've got a fairly pragmatic net zero target. Well, I say pragmatic, it's quite punchy at 2040. It's something we're looking at the moment, aligning that and what that applies to. But we've never tried to be, applying values to our investments or trying to guess the values of our members, because it's just a bit of a fool's errand.
Yeah, it's complexity involved, isn't there? I mean, that's the thing. I think sometimes you could become quite a virtue signaler, and you could build today a perfect green portfolio, but you wouldn't stop the planet from burning alive.
Yeah.
Sometimes you have to get your hands dirty, don't you? You have to go green, to go brown, to go green.
Yeah.
And you also have to change your definitions. I mean, is net zero still realistic? Not even if it's 2040, but I mean, are the kind of like where we think we're going to hit in terms of degrees, does that need revisiting? Because I think we've blown through 1.5 degrees already.
We have, yeah. And I kind of lament on the mistakes that maybe we've made as not just pension schemes, but politics and more globally around how hard I think we pushed at the beginning. Maybe that was fine to an extent because we didn't have some of the energy conflict that we've got now. But there was always going to be people that lost jobs and people that pushed back. And actually, maybe if we'd taken a step back, I know that there's a lot of just transition work as well, which tried to address a lot of that, but that probably maybe came a bit too late and maybe too small and too siloed. So, yeah, in my mind, I think if we'd just taken a step back at the beginning and thought kind of how do we build for 50 years rather than trying to achieve everything in the next 5 to 10 years. But you're right, we've blown through various degrees of scenarios that we've got, and I think we need to be pragmatic as to where we can go from there. But I mean, it's great to see people like, genuine China that do huge things in renewables, and hopefully we can take some lessons from them as well.
Yeah. I mean, to be fair to asset owners and asset managers, I mean, you can't do everything yourself. And if you talk to a policy wonk about this, they could just kind of shrug their shoulders and go, well, I mean, this would be a lot easier if we had some legislation that just made it easier, right? Like that just forced people to make the changes that they needed to make in the time they needed to do it. And there's kind of been a collective reluctance around the world to do that. I sort of understand that. And there is also a feeling like, well, we're just a medium-sized nation in the middle of the Atlantic Ocean, and no matter what changes we make, what difference is that going to make? But I don't think it should all hang around the neck of asset owners and the financial services sector. I do think there needs to be more policy decisions, and to flip the blame maybe a bit back on the financial services sector is kind of the weird dichotomy that we operate in this highly regulated sector, yet nobody seems to have grasped the fact that they actually could campaign and maybe make some changes and use that in their advantage. So yeah, it's a weird scenario. It's kind of like everybody operates in a regulated sector but sort of forgets that they do. It's very strange, isn't it?
It is, yeah, it is. And I think we're almost too reactive rather than proactive a lot of the time. We're reactive to Mansion House and these sorts of things, but actually if we'd been more proactive 5-10 years ago, we probably wouldn't need these sorts of things. So yeah, we do tend to solve the problems eventually, but it's generally too late.
Well, then look a bit horrified when new policy arrives, rather than sort of being in there and trying to shape the discussion in the same way you would with the client, as having a discussion over a long period of time. It's genuinely weird. But I can't quite believe, I mean, I know I've been doing this for quite a long time, but we really have managed to cover an awful lot of ground in just under half an hour. I am impressed. The full guide to how you should invest in private assets, a big debate about prices, internal, external, bit of green tech, talking about sustainability. I'm well impressed. So I'm going to say I think that's enough material for our listeners to wrap their heads around. And thank you so much for all of your insights and being on the show, James. You've been a great guest.
Thank you. Thanks for having me. Appreciate it.
And I just want to say to our listeners, do make sure that you hit the subscribe button so you never miss a future episode of the Professional Investment Podcast. Please do interact with us, comment, take part in the Spotify poll if that's the way you consume your podcasts. And as ever, thank you so much for listening.